The Personal Finance Executive Summary, November 27th, 2013. Welcome to Personal Finance. Market Watch. U.S. stocks have been continuing their journey in overbought territory, with a long-expected pullback that has yet to occur. The S&P 500 hasn't undergone a 10% decline since August of 2011, much longer than average, but hardly unprecedented. We've seen long periods of growth before. Although no longer cheap, the stock market is hardly expensive, particularly with the economy growing modestly, as well as rock-bottom interest rates. So this is a time to be neither complacent nor fearful. Limit new investments to those that are off their highs. Otherwise, just wait, watch, and profit. In light of the approaching holiday season, we've been paying particular attention to the high end of the retail market. In our article, Luxury is Looking Good, analyst Quan Nguyen points out that North American luxury sales in 2013 are expected to show growth of between 5% and 7%. Global lifestyle brand Michael Kors should get a lift from improving economic conditions both in the US and in Europe, where a majority of its operations are based. Michael Kors seems to be immune to downturns. Even during the low point of the Great Recession of 2008 and 2009, it managed to increase revenues while the rest of the luxury industry saw sales plummet. Michael Kors is a buy, up to $90. Men's luxury clothing maker Hugo Boss is best known for its suits, but it offers a wide array of clothing and apparel. While definitely in the luxury market, its products are still accessible to a broad range of fashion-conscious consumers. This accessibility includes geography. Hugo Boss will be opening new stores in China and other Asian countries over the next 2 to 3 years to reach fast-growing markets, an expansion that promises to be a big growth driver. Meanwhile, the company offers a solid annual distribution that equates to a 3.2% yield. Hugo Boss is a buy, up to $28. And now for our feature article, Screening for Value, by Benjamin Shepard. As investors try to cope with today's market uncertainty, they need to focus more than ever on the fundamentals. That's why our personal finance portfolios feature established, financially strong companies with dominant global business franchises. We also like companies that consistently hike dividend payouts, because the reality of inflation is more scary than you think. While the US government's official Core Consumer Price Index, CPI, shows only 1.8% inflation, real inflation is much higher, closer to 9%. Deduct inflation's bite from your net worth and income each year, and you start to get a little concerned. But smart investors can take action now. Nearly 40 years ago, we started this company to help investors defeat and survive during the perilous economic days of the 1970s. To this end, we have a special announcement. Our first newsletter was the Inflation Survival Letter, and with it we helped thousands of investors like you beat inflation. In the 1980s, when the economy turned around, we launched other newsletters, including Personal Finance, and closed the Inflation Survival Letter. But the market has turned again. As investors try to cope with today's market uncertainty, they need to focus more than ever on the fundamentals. Solid balance sheets and reliable revenue are key factors for weathering market downturns with wealth building intact. We are pleased to announce that we have relaunched the Inflation Survival Letter. This is to help investors like you identify investments that will overcome inflated prices and wealth-stealing costs. For the real story on inflation and complete protection from its ravages, learn more about our new Inflation Survival Letter. Click the link next to this video. Thank you so much for watching, and join us next time for the executive summary of Personal Finance.